So this question you see how we have 1 to 7, the requirements step by step. But first we need to take a look for the bond issue in general, like will it be sold likely to be as premium or as discount, because that's a major direction we need to know in the beginning. And I believe this one still be a bond discount. So we can see you have the state rate, 10%, and the issue time, the sales time. The face value is 800,000. And the market yield means the market rate for the average investment in the market is 11%. And the maturity time is 4 years later. And interest is paid semi-annually on June 30th and December 31st. So the interest payment date tell us how often we need to recognize the interest expense, and also related how long the amortization will be. And for easy questions, we are trying to make the interest payment corresponding to the calendar time, right? So you don't need to adjust for the partial interest. But in real practice, lots of the time, the interest may not fall on the calendar time. So we have partial interest to be adjusted. We have a brief example from Tuesday's lecture. But this one, let's see so first requirement, because the state interest rate is lower than the market rate, 11%. So we have to discount the bond sale, but how much the discount will be, we need to get it through the calculation. So number one is asking calculation for the bond price only, or you may have slightly different number than mine. But once we know the calculation, okay, you will be able to figure out your own issues. And the second journal entry is the issue. The second is for journal entry for sale the bond with discount. You already know we will have discount. And then number three is prepare the entire amortization table, because we have 4 years and the semi-annual interest. So you will be able to know you need to have a Excel. For example, if I use Excel, I will have 8 different periods. So 8 6 months for covering all of the amortizations. And then the first interest payment journal entry, as of June 30th, 2024, first interest. And then if you follow, like for the other, all of the remaining interest payment, it will be similar, but with the different amounts from your amortization table. And then it's asking the financial statement disclosure by the end of 2024 is like after the second interest payment. So how we disclose the related information in the balance sheet for the bond payable, bond discount, and the related interest expense on your income statement. And finally, if you assume we hold the bond until the due date, the journal entry to retire the bond. So that's a simple bond, but covering the whole bond issue period. So calculating the pricing, you need to use the amortization tables. You can use the tables with the question. They give you 6, but mostly we only need, so if you already learned, so we only need the PV, the second, present value of $1 for the maturity amount, and then the present value of the ordinary annuity, with the first one, with this one, PVA. They didn't use PVOA, so ordinary annuity, but PVA. But PVAD, the last two, the AD means annuity due. With the annuity series, you have the cash in the beginning of each period. So it's annuity due, but we have ordinary. So period, so N equals 8, right? So it's 2 times 4. 4 years, but semi-annual, so N equals N. The discount rate is your market yield, so half of the 11% in my question. And the interest, you calculate the cash interest based upon the state rate. So it's 800,000. I think I have, oh yeah, here is the calculation. So the interest is 40,000 with this one, so 5%, 10 divided by half of the 10 state rate with the face value. So cash interest and then the maturity amount is 800. So the 40,000 interest, you use the PVA, so present value of ordinary annuities. So 6 points, right? So totally we have N. Sometimes I see, like, you know, when you calculate, some people make easy, like a very apparent error or mistake. Because if you use a PVA, you should know this factor should be larger than 1. So sometimes the people use the wrong, they check the wrong table. You go to something, I don't need to check the details, but I already know, for example, if you go to something lower than 1, like for this ratio, or like 1 point something, 2 point something, that's too low. Because by the common sense, if you are looking for a present value factor for 8 periods, I know approximate it should be something 6 or 7 or 5, kind of like in this range. Even I don't look for the tables. So if you get something like a 2, like a 1, or like 0 point something, I definitely know you are referring to the wrong table. Also be careful when you're applying for the factors. So the total present value for the annuity series, and then the principal, the maturity value, they use the present value of $1. And this one, you know, it should be smaller than 1. And if you go to something larger than 1, again, you are definitely wrong. I don't really need to check your calculation for these two. Because lots of the times these days we rely upon a calculator or some like the online tables, and without really having this common sense, it's very easy to make a mistake. Okay, right, so it wouldn't really help. So present value of ordinary annuity for the interest and the present value of $1 for the maturity amount. So we have a slightly discount, not too much, because now back to here, you can see the state rate is only 1% than the market rate. So you know you will have discount, but the discount wouldn't be too much. So we have about 25,000 something, right? So compare with the face value 800,000. And be careful of these rounding things. Okay, if you put it wrong, because this is computer grading. Okay, if you didn't fall into the range, you may still get something wrong. Okay, be careful of the rounding requirements, rounded to the whole dollars. So for dollars is the whole, and percentage like 1 decimal point. Any question? So we review this for the overall bond price calculation. If you issue at a premium, so if you sell at a premium, the market rate will be higher than the state rate. Then you should get something, the price will be higher than the face value. Okay, that's premium. Yeah, I see more people joined. Question? So again, my purpose, even when you do the homework, I believe always the goal, okay, like higher goal is not only completing this assignment, is review, after you finish this particular question, you should expand your scope. Okay, what other question or what other related study points, or like the material or like the learning goal to work on this problem. So the general learning goal for this part of the question is review the calculation of a bond sales price. If you are the investor, okay, you should also know. Okay, so this calculation is both for chapter 12, investment, and chapter 14. Then requirement 2, making journal entry. Recognize the calculation we have finished in step 1. Again, the learning goal for this is making journal entry for the seller, okay, for the issuer. Discount. You should also think, can I handle premium? This one is for discount. If I change this to premium, how the journal entry will change. Again, even broader, if I'm the investor, if I'm the buyer of the bond, how I should make my journal entry. So for one question, you can derive it in 4 different situations. For seller, discount or premium. For buyer, discount or premium. And this is for discount. Initially, when you sell, the cash you receive is always lower than the face value because that's a discount. So the initial discount should appear on the debit side to make the journal entry balanced because we need something on the debit. So no matter, so I'm not really looking for the numbers, I'm looking for the general. So you should have 2 debits and 1 credit. And if you change this to premium, so think about, if you have a bond sale as a premium, how this journal entry needed to be adjusted to reflect the premium. Do you have another picture in your mind, or just write on a paper briefly? So I sell the bond higher than the face value. For example, 820,000. The cash will be larger than the bonds payable, right? Then in that case, the premium will help you on the credit side to make this balanced. So the initial premium for seller should be on credit. Again, I don't need to memorize as long as I know which one is larger. Okay, the bond sale, the price is larger or the face value is larger. As long as I know those two, I should be able to figure out, should I put the discount on debit or the premium on debit, okay, for both situations. So issue bond sale initial journal entry. Then this one, I don't know, you probably can do it in Excel or then copy, okay, paste it. So copy the numbers to here. I believe this is nice. I like this. So you really need to practice the 8 different periods among the discount, all the way from the sale. Again, be careful about your rounding, with the rounding. Only the cash payment, so we have the whole dollars or all 40,000 for all of the 8 periods. But the effective rate will, all of the rest of the 3 columns, we have some rounding happened. So when you use the outstanding balance, or you can say the book value or outstanding balance, be careful. Okay, that's the one later we disclose in the balance sheet. And the effective rate, the interest expense, we disclose in the income statement. So outstanding balance means the bonds payable, the face value with adjustment for discount, that's shown in the balance sheet. So you know we have this, so the first balance multiplied by the market rate. Okay, market rate is always for every half year is 5.5. So you will have some rounding things. And the difference between the market rate and the cash payments is the amortization for your discount. So we are reducing the total discount, okay, period by period. But the amortization of the discount, again, will help you increase the outstanding balance. So moving the lower outstanding balance gradually to finally the face value, the state. Remember the trend, right? So we have the trend in the slide. For discount, we start from a lower outstanding balance and is gradually reverting back to the face value. So from lower to higher. But if you have premium, you start from higher and gradually drop back to the face value. Okay, the trend, the trajectory is different for the premium sale and for the discount sale. Then second year we continue. But again, I really recommend you use Excel, and in question 4, there's another practice. So import, you only need to set up I probably like the first row and the second row. Once you set up your formula correctly, you can just copy, right? So copy and paste the formula to rest of the periods, and then ask the Excel to round to whole dollars. I think you should work it out. It wouldn't take that long. But as long as you understand the relationship, okay, for these four different columns. Okay, similarly, we did something already in chapter 12. Okay, but that time we did it to help the investor, but this time is for the issue company. And briefly, quickly check out your calculation. Okay, so everything can fit. Like after all of the 8 periods, you should have the total interest. So do a total column, okay, like total row after the 8 periods. So the total cash interest, total effective interest, and the amortization add together, it should be your total discount in the beginning. We amortize among the different periods. And remember, if you can use the straight line amortization, it will be averaged. So the easy way, or they call like expedient, there is easy, practical, easy way to do the amortization is by average the total discount, okay, over 8 periods. And your final book value outstanding balance should be equal to the original face value. If there is like $1 or $2 because of the rounding, force it to equal to 800,000. Because if you put something $1 or $2 different, the grading they will mark it wrong. Okay, for the eventual adjustment for the face value. Questions? So easy ways to do it in Excel, okay, and then copy the numbers to here. Any question so far?
No.
Okay, yeah. So requirement 4 is again, the learning point for this is making journal entry for the interest date. Okay, you can expand this. I can ask this question for any of the 8 interest payment date, but for the requirements, we are only doing for first one, June 30th. But as long as you finish this table, you can write a journal entry for any of the interest date. Okay, so that's only the first one as example. So interest expense will be the effective interest column, right? And the cash payment will be the cash. Okay, always 40,000. So the only account will not change is the cash, always 40,000. But the discount and interest expense will reflect the different time period. Okay, the first one, second, and I believe the first one you have the smallest. Because if you see the trend, the amortization will become larger, right? So larger and larger, gradually increasing. That's also the amortization, and the effective rate will be larger over the time. The first time is the smallest. And discount amortization will appear on the credit side. So again, don't memorize, or if you memorize, unless you have very good memory, it's very easy to like mess up. But as long as I know my interest expense should be higher than the cash interest, then the amortization should be on the credit side. And the premium, okay, again, like if you have premium, again, offset, the premium will be on the debit, because in that case, the interest expense will be smaller than the cash interest. So we have to put the premium on debit side, amortization. One more time, if you want to expand, if you want to review, you can think about the related journal entry for the buyer or for interest. If they receive this interest revenue from the selling company, they will recognize investment revenue or interest revenue, and they also need to, the cash they are going to receive will be 40,000, but the investment interest revenue will be the effective interest, and also they needed to adjust for any discount or premium. So the seller's adjustment or the buyer's adjustment. And for the bank financial statement disclosure, okay, let's take a look for the amortization one more time. The disclosure will be at this time, okay, after the first year, the second interest. So they are asking, so how we should, so which information we disclose in balance sheet and which information we disclose in the income statement. For income statement, I believe we only have this, the second column, your interest expense for the whole year. Okay, for the whole year, so you should add the first interest and the second, the effective rate. That will be the total interest expense, rather than only this second one. Okay, be careful, it's looking for the whole annual reporting. Then for the balance sheet, we need to disclose the face value for the bond, the 800,000. The bonds payable will be 800,000 always. And then the remaining discount. The remaining discount, we should use the total discount minus the first amortization and the second. So it means you need to minus 26, then minus 27. Okay, what's the left over? And then the outstanding balance should be this 780,019. But how you don't get this directly. Okay, the balance sheet is not replicating your amortization table. You need to show, let me see, yeah. Yes, it's easy, like they put it, but the detailed thing, it should be the bonds payable minus the remaining discount. Okay, like you should get this. And the total interest expense. So adding the first effective interest and the second. Okay, let me see, do they have the yes, the explanation is here. So how we get there are two ways. Okay, you can use your amortization table information and looking for the outstanding balance by the end of 2024. Or you can use the face value minus the remaining discount. The remaining discount will be 25. So can I write it down in the note? So let me type in the note in the chat. Okay, so you can see the other way we can doing this. So I can use the 800,000 minus the remaining total discount. And the remaining discount, it will be the total discount we have in the beginning. I'm trying to juggle between my different windows. Oh, here I can do it. So 25337. Yeah, I type it in the chat. This give you a overall view, okay, like how I can get this the balance sheet disclosure. So you can directly use your amortization table, or you use the other approach. We use the face value minus the remaining discount. So you should get the same $780 and $19, okay, book value. And that's for balance sheet, the liability side. And then for income statement, the interest expense, we need to add the two interest for the first period. So the two effective rate. Be careful, not the cash interest. The cash is your payment, but is not your cash expense. So it should be your effective interest expense, not your cash expense. And easily they can put like 80,000. Oh, but 80,000 is the cash payment. Again, think about if this is a premium case, or how it will be different. For premium, you can directly use your amortization table, or you can use the face value plus any remaining premium, okay, to fund the balance sheet. Is in the chat. And finally, the maturity interest. Maturity one, like the maturity, I believe if you needed to adjust for the final, so let's see, requirement 7, prepare the appropriate entry at maturity. And that time we will have the last interest payment, with the last interest payment and plus your the face value payment or return of the premium. So again, if you're looking for the last days, it should be something here. Okay, so you should reflect this last interest plus the maturity value go back to the investor. Okay, that's requirement 7. So 2 journal entries. So the last interest payment, based upon period 8, then the bonds payable will be canceled, will be reduced, and the cash will be paid by the maturity amount. And even you have premium, the premium payment, the maturity payment, there will be no difference between premium or discount because all of those discount or premium has been adjusted. The face value is the same. Okay, so we are paying the maturity by the face value. That's after 4 years. So question, the first homework. So it's a, what I say, like the life cycle, okay, overview for the life cycle for a bonds payable. But you can expand, think about a situation, use premium. The second question is a straightforward one, or is trying to demo or practice how to determine the gain or loss when you early retire a bonds payable. Or it means we call the bonds back, the book called early extinguishment. For early extinguishment, we need to compare the outstanding balance for the bond and then the calling price, like how much pricing we are calling the bond. So normally you have gain or losses. And in this situation, when the company called the bond back, the face value is 91.8. Be careful, that's the face value. And the bond has been issued in 2016, okay, right? You can see almost 7 years and something. And we have a remaining discount for 0.8 million. And call the bond back at a calling price 105. So what's 105 means? So call the bond before the maturity amount at a call price 105. So 105 is a percentage, remember, right? So is a premium indication. So probably I think this is 105% of your face value. So you call the bond back, so paying a 5% premium. Let's check the calculation. Okay, this one, yes. So this is a calling price. So 5% higher than the face value. Be careful, not 5% higher than the outstanding balance. Okay, so 105 is always referring to the face value. So definitely we are calling it back higher. So you can see that's the price, so we can know the calling price. Then how much is the outstanding balance now? The outstanding balance is, let me see, the remaining discount is, they already tell you immediately, okay, so 4.8 million. So we are reducing cancel the bonds payable by the face value. Then you are paying higher price. The price is 15% of the face value. Then we need to remove the remaining discount with 4.8 million. Then finally, you can insert a loss account. Okay, definitely we should have loss rather than gain. And how much this loss? You compare the total of the face value, the debit, and then the total of the remaining discount, and then the calling price. So you have about 9 million loss because of the early retirement. And we paid much higher than the face value. Initially is a discount, but you even paid higher. okay, than the outstanding balance. So again, I'm typing this, okay, how we know this is a gain or loss, you need to, so the gain or loss, we decide based upon the direction for the difference between the face value, your remaining discount or premium, and then calling price. And they didn't show it here, but if you compare the bonds payable, use the bonds payable minus the discount, that's your outstanding balance. So use the outstanding balance, compare with this, you should have the same loss on the early extinguishment. And if you call the bond back not exactly on an interest payment, we may have partial discount. Like I'm saying, in the actual practice, we can call the bond, or it may not fall on an interest, like a whole interest date, then you may adjust for the interest be between the last interest payments and the calling time. And finally, this is convertible bond for the bond with convertible features, and is asking for, let me see, the issue of the convertible bond, interest adjustment, and assuming this time we are using the straight line amortization, okay, for both the buyer and the seller. Then finally the conversion. Did they convert all of them or partial conversion? Everything, okay, you convert all of them. But before you again prepare the journal entries, get a basic understanding for what the bond issues and the conversional features. And because the conversional feature tells us how the value will be converted to the common stock. So we have the bond face value is 15 million, state rate 8%, and 10-year convertible, okay, 101. When you have a convertible feature, normally you can sell the price a little bit higher, right? So like maybe like a little bit premium. Okay, 101, we have 1% price premium. And each 1,000 bond can convert to 40 shares of no par common stock. So it means we don't need to worry about the excess of par value, okay, no par. And then without the convertible feature, the bond can be sold at 99%. Means you will be sold 1% discount, but now you sell 1% premium. So means the value of this convertible feature give you 2%. The price or value of the convertible feature worth 2% of the face value. And Century Service purchased 10% of the issue at as an investment. So that's like for the buyers. So now let's looking for the 3 different requirements. Because for the buyer, they didn't buy everything, they only buy 10%, okay, of the whole issue. So the first one, the journal entry for the seller and for the buyer. The buyer, we are only buying 10% from the bond issue. And based upon the American, the US GAAP, we don't need to show the equity value separately. Okay, when we sell the bond, we are selling it as a regular issue. You don't need to separate the value of the bond and the value of the potential convertible equity. So you are getting 101% of the face value as cash. So there is a 1% premium. Okay, so that's 150,000. That's for the seller. But for the buyer, we are acquiring 10%. So that's 1.5 million for the face value. And the premium is also 10% of the total, and then the cash or cash payment. So both sides you have premium, but one is the seller's premium and the other one is buyer's premium. So this is a good practice. Let us review again the bond issue from both sides. And then second, journal entry is the first, I believe is the first or something, right? The interest adjustment, after 4 years. Because this one is using straight line depreciation, so that's we don't really need to draw the whole amortization table, right? So because all of the periods, the amortization of the premium will equal to each other, average method. So there is an explanation. For each of the interest payment date, the premium amortization is this one. Okay, we use a straight line approach. You can see 150,000 total premium divided by 20 periods, 10 years, but 20 half years, okay, semi-annual. And the cash interest is 4% with the face value, 600,000. And interest expense will be the difference between the cash and the bond premium amortization. So on the premium amortization, the interest expense is smaller than the cash interest. So that's why you can sell at a premium. The calculation for the buyer is the same, but it's only 10%. Okay, so it's like a smaller, only 10% of the related calculation on the seller's side. So 60,000, the cash interest, premium amortization is 750, and the interest revenue is also 1%. So straight line depreciation. And now when we get back to, so you can tell. So you don't need to worry about this different periods. Okay, every interest periods we have the same calculation. And finally, assume after we did this adjusting, after we did this interest adjustment and they convert, we convert all of the bonds issued in the beginning of 2029. When you convert it to requirement 3 for the seller, okay, the first one, so you convert all of the remaining, like the bonds. Let me see. Between these two has a market price. We don't worry about the market price. I think this one you are using the 40 like this. Okay, every 1,000 bond convertible to 40 shares, and this one we are converting this 10% because like the investor. Okay, so only this investor is converting. So both are converting 10% of the total share of the total value of the bonds payable. So the bonds payable is 10%, 1.5 million. And the remaining premium for the bond is 6. So it's 10% of the total. And how we know this, you can see this one, be careful. How you can get the remaining premium. So we need to do some calculation, okay, in the scratch paper and put So total premium is 150,000. And by the beginning of 2029, you already amortized the 11 period, 11 half years. So 7,500 times 11, that's how much has been amortized. And then the remaining, we have 9 remaining unamortized period. So that's how you get, then multiply the 10%. Then how you get this 6,750 remaining premium. Then add the premium and convertible, the bonds face value, then that's equivalent to the total common stock. So we don't really need to apply the market price for the shares because all of these value will be converted to equity. So I think this is the amortization, okay, should be the something is not really given by the question. Okay, we need to figure that out before you can do the journal entry correctly. So when these numbers are figured, then the investor, they will do the opposite. They still have investment, but they change categories. They change from the bond investment to stock investment. Okay, less change. So still as your investment assets and then remove the related premium. But for the seller is a categorical change from debt to equity. And that will kind of change your related financial ratios. This question is also a good one. So let you practice a little bit on the straight line depreciation for the amortization. Okay, you can see the life cycle kind of for convertible bond. Be careful, even that we didn't really use this information, like this market price of the equity, the common stock, or like these converting features. Unless you want to find out the par value for each share, okay, after we do conversion, how much equivalent, so maybe like a multiple choice, and they ask you how many shares, equivalent shares we convert. Then because we are converting 1.5 million, remember 1.5 million divided by this 1,000 rather than times 40, that will be the total shares. Okay, we like you increase the number of outstanding shares. So convertible. Then I'm not really talking about the Excel, but you can do. So you really know the contents already. The only thing is get more familiar, right? So with how to use the Excel, and this is the Tableau. They have the step-by-step instruction, okay, to finish this ratio calculations, okay, for the data analytics stuff. I think that's almost for me, and that's kind of go back to our regular class time. But any questions? And email me, okay, if you have more questions, when you work on the homework. And no class for next week, but I'm still available using Zoom. Well, I will have a review session, like a review reporting for the exam. And I will open practice quizzes in Connect and let you know once it's ready. So for you, the remaining thing before next Thursday is finish this homework and finish the quizzes as additional practice and then start the review. So for second exam, we only have chapter 13, current, liabilities, contingencies, and this chapter 14. Any other questions? This one is recorded. or if you needed to come back, you can review, okay, once I upload to the YouTube.